Hello, hello. Happy Monday. All right. The sun is shining really bright today, which is great, but it made for figuring out a place to put my camera difficult because I had it over where it normally is, but that let's see if I can, there we go. That window was like terrible. Then I moved it this way, but then that window was terrible. Hot mess. So it's fine. It's good. It's good that we have some sunshine. Lately, it's been really smoky, not only from the Colorado fires, but from there's fires in California and Oregon, and I think Washington and Nevada. I don't know for sure that those two are right, but I know for sure we're getting smoke from California because their fires are so bad. And so those on top of the ones of the fires here in Colorado. There have been days where we can't even see the sky. Today, it's exciting. You can see clouds in the blue sky. So we know it's great. But again, so like it causes camera problems. So happy Monday, everybody. Another week. I don't know about you guys. So I used to hate Mondays. Okay. I hated Mondays because, I mean, do you know very many people who like Mondays? It's kind of stigma, right? Like you're supposed to hate Mondays because signifies the end of the weekend and the beginning of a new week, and you got to get back to work and all the things. But I've learned to really embrace Mondays as a chance to almost start over, right? You get a fresh start at a week to be productive and try to get through your task list. And I like Mondays now. Hence part of why we do our lives on Monday, because I'm good. I'm good with Mondays now. So as you jump in, be like Ellen and say, hey, let me know you're here. Let me know if you got any fun plans for the week. If you did anything fun over the weekend, chat it up. I'm here. As always, we're going to give everyone just a few minutes to jump in. All right. So I don't know, but yeah. So when when the people I follow have lives, I get the little notification, right? But then I don't jump right over there. I got to finish up what I'm doing. There's an email to finish or, put whatever it is you're doing. And then I jump over. Then I get all bummed if they started right away because then I missed something. So I always try to give everyone just a few minutes to wrap up what they were doing and jump on over here. I'm really excited to start today's training and to start our whole series that we're going to be doing on retirement. We're just going to call it the retirement series. So I'm not sick. I've got really bad allergies, which I know because my eyes are itchy. And then it's also, I did say the smoke is better today, but the smoke is still there. So between the smoke and allergies, it's like gross. All right. I think I've given everyone enough time, almost 5 minutes. So let's jump on in. All right, y'all, I'm happy you're here. For those of you that may not know me, I don't know how that's possible, but I am Bree Beers of Bree Beers and Associates, formerly Lipa Beers and Associates. And I am a CPA with a goal to enlighten taxpayers and business owners on all things accounting and tax. I understand that y'all don't know what you don't know. And so our team is dedicated to creating all the tools we can to help shed some light on all of that unknown. You guys, Jamie Trull is here. No big deal, but she's kind of a big deal. So say hey to Jamie. Jamie, hi. Squirrel. So one of those tools, you guys, is our awesome Facebook community, Money, Taxes, and Finance for Small Business. And if you are a business owner and you're not in that group, and please head over there. It's a fantastic group full of just a small, supportive, and amazing community. We post daily tips and tricks, and we provide multiple live training events each week. So Mondays at 9 a.m. Mountain Standard Time is our normal live training session time. So this is where we're talking about all the topics that you guys are asking about most often. And then on Thursdays at 2 o'clock Mountain Standard Time, we go over updates from the past week, and we open it up to live Q&A. So that's where I will pull your guys' questions from that you DM me, email me, that you post in the group. I'll use those for ammo. And then if you guys catch us live, go ahead and jump in and ask those questions live on Thursdays. All right, guys, let's take a drink of coffee, take a deep breath, and let's dive in. All right. So today is part 1 of our retirement series. So during this series, you guys, we're going to look at a variety of retirement plan options, but we're going to look at them from a very high level and then a tax-oriented view. All right, I got to throw in a disclaimer that I am not a financial advisor. I'm not a financial planner. I'm a CPA. And so I am a CPA who, that doesn't necessarily make me not a financial advisor. There are people who are both, but I'm a CPA who I specialize in tax strategy and tax advising. Okay, so I am going to look at these various options from a tax perspective and give you that information. All right, so I do always suggest that you get yourself an awesome financial advisor. I have a few that I partner with, and I'd be happy to refer you. But if you want, financial planning and investing into your retirement and doing all these things is something that one of your goals that you want to get started on, definitely, you should have a financial advisor. All right. So one quick pro tip right out of the gate, from tax advisor, right, to business owner or taxpayer. Okay. From me to you guys, I suggest that if you do have a financial advisor and a tax advisor, and again, I think everybody should, then make sure they know of each other's existence. All right. Our firm tries to build relationships with our clients' financial advisors, we recommend our clients to financial advisors that we work well with. All right, financial advisors and your tax advisors, they're not going to necessarily have the same goals, right? Your tax advisor is trying to minimize your taxes, and your financial advisor is trying to build your portfolio based on your retirement goals. So when you have an advising team that works together, they can actually do both for you. Okay, there are strategies that can build your portfolio successfully and provide you with tax saving strategies. Okay, but you need a financial advisor and a tax accountant to do that. All right. So today in part 1, we are talking about IRAs. All right. So first, we want to talk about individual. I don't even know what the A stands for, you guys. IRAs. But there's 2 main types of IRAs. There's Roth and traditional. Okay, and I always get so many people, that's the question. Which one do I want to invest into? What's the difference between a Roth and a traditional? Or I get clients coming to be telling, hey, my friend says I should max out my Roth, and so I want to do that. But before you make any big decisions with your money, right, that's your hard-earned money, I want you guys to just kind of have a little bit of background about where your money is going. All right, so let's start by talking about traditional versus Roth IRA. All right, so a traditional IRA, you guys, it's called traditional because the tax treatment is traditional. So it's in line with other retirement plan types that you hear, like specifically 401ks. So what this means is the contributions are made using pre-tax dollars, meaning they provide a tax benefit for you in the year you make the contribution. All right, so if you make a $5,000 contribution this year to a traditional IRA, then you are in essence reducing your taxable income by that $5,000. All right, so as a tax advisor, I love, anything that's pre-tax because it's going to save you money this year, okay? This is especially beneficial if you are in a high tax bracket, if you know you're going to owe a lot of taxes, right? So contributing to your individual traditional IRA, great thing to do, all right? Important to note, you guys, that when you retire and you take that money out of your traditional IRA, you are taxed at that time, all right? And you're going to be taxed on those distributions, both the principal, meaning the money you originally put in, and the interest that you earned, all right? So all the money you pull out of your traditional IRA when you retire is all going to be taxed at that point. So traditional IRAs, similar to many of our retirement instruments, are really a tax deferral tool, okay? We're moving taxes from paying them now to paying them when we retire. And that can be a really big benefit, right? For many of us, especially if we're in a high earning job right now, or we're making tons of money, our business is doing great, whatever it is, we typically like to think that if we're in our 30s, 40s, maybe even 50s, that we are in a higher tax bracket than we're going to be when we retire, right? Because our thought is we have to make more money now because our cost of living is higher now than when we retire. Again, this is kind of going more into financial advising, so not my cup of tea, but that's traditionally what people, what a lot of people kind of envision when they're deferring those taxes is that they're in a high tax bracket now making lots of money. And when they retire, they're only gonna, they're gonna make a lot less money. So they hope to be in a lower tax bracket. All right. But if you're in the highest tax bracket now, deferring your taxes makes sense because at the very least, you'll be in the same tax bracket later, right? So deferring those taxes to later, that's what a traditional IRA and a lot of your retirement tools are doing. They're deferring taxes. All right, so who can contribute to a traditional IRA? So actually, guys, anybody who has earned income or taxable compensation can contribute to a traditional IRA, as well as your spouses. So this is important. If I work and I'm the breadwinner and my husband is a stay-at-home dad who doesn't work, we can both contribute to an IRA as long as I have enough taxable income to cover our contributions, in taxable compensation, earned income. All right. However, there are income limits to actually deducting the contributions. All right. So you know how we said it's a tax deferral tool. We don't pay tax now, we pay tax later. Well, that benefit is because you're deducting your contributions, but that deduction is only available if your income is under a certain threshold. So for 2020, your modified adjusted gross income, which can be found on your tax return, has to be less than $124,000 if you're single, or less than $196,000 if you're married to fully take that deductible contribution, to fully deduct the contribution. Okay, if your MAGI, modified adjusted gross income, is over 139 or over 206,000 married, you're not going to be able to deduct any of those contributions. And if it's in between, you're in the phase out period, okay, or a phase out range, so you're going to be able to take a partial deduction. Okay, but the key to know are those first numbers: $124,000 if you're single, $196,000 if you're married filing jointly. All right, as long as you make under those thresholds, your traditional IRA contributions are fully deductible. All right, what are the rules of a traditional IRA? So they're pretty simple, okay? Taxpayers under 50, you can contribute $6,000 in 2020. That's your max contribution amount for your traditional IRA, okay, for any IRAs actually. We'll talk about Roth in a minute. If you're over 50, you can actually contribute an additional $1,000. It's called your catch-up contribution. And you guys, the cool thing about contributions that people miss a lot, especially when they don't have tax advisors, is that those contributions can actually be made up until you file your tax return. Okay, they do not have to be made by December 31st of this year. All right, so perfect example here. So I'm a CPA. So I'm a tax, it doesn't matter that I'm a CPA, I'm a tax accountant, okay? And so my heaviest income season, right, is first quarter, right? Because our deadline is April 15th. That's when most of our cash comes in. The end of the year, let's say I'm a little, when you're seasonal is what I'm going with. So at the end of the year, let's say December 31st comes around, I'm like, oh man, I don't have $6,000 to contribute to my IRA, but I will next month when tax season revs up. Perfect. I can actually make that 2020 contribution in 2021 up until the point that I file my tax return. All right, pretty cool. So next, you guys, I want to talk about Roth IRAs, because this is the one where people come to me and they're like, I'm being told I'm told I should contribute to a Roth IRA, that it's so awesome, it's so beneficial, I should be maxing out my Roth IRA, but people don't know why. Why is that a thing? Why is that beneficial? All right, so let's start with what is a Roth IRA. So you guys, a Roth IRA uses post-tax dollars to contribute. So the traditional IRA, right, pre-tax dollars, so it's a deduction this year. Roth IRAs are not a tax benefit in the year you contribute. Okay, not a tax benefit in the year you contribute. So opposite of a traditional. Okay, but bigger benefit, and I'll tell you why. Because the tax benefit comes when you withdraw the money. So if I contribute to my Roth now, okay, I'm using post-tax dollars, not a tax benefit, but in 30 years, when I withdraw my Roth because I'm ready to retire, all of that money is distributed and withdrawn tax-free. Okay, the principal tax-free because you already paid taxes on it, right? I pay taxes today on the principal, so it's mine to take out tax-free when I'm ready. but the interest, you guys, also grows tax-free. That's huge. Okay, that is huge. So you pay tax on the money today, then you get it tax-free at retirement. So this is the opposite benefit of a traditional IRA, right? We were talking about with a traditional IRA or most retirement contributions, it's pre-tax now because we anticipate being in a lower tax bracket later, right? Or there's many reasons, but it's a tax deduction, right? With a Roth IRA, it's the reverse. People contribute to Roth IRAs when they're in the lower tax brackets now, all right, thinking that they'll be in the same or higher tax brackets when they retire. So Roth IRAs are great for those of you that don't feel like you're making a lot of money, are making less than six figures, okay, because you are in those lower tax brackets, all right? So, and you guys, even if you're in a high tax bracket, all right, as long as you're under the contribution threshold for a Roth IRA, it's beneficial because Roth IRAs are not just a tax deferral tool. They are a tax savings tool because of that interest growing tax-free portion, all right? So let me put it all together. So traditional IRAs, I put in pre-tax dollars now, I take out principal and interest when I retire, and I pay taxes then. Roth IRA, I put in post-tax dollars now, meaning after tax, right? Then when I retire, I get to take out the principal tax-free plus all the interest that's earned, which if I start my Roth early, that's a lot of interest, which means a lot of tax-free income. All right, so Roth IRAs are not just a tax deferral tool, they are actually a tax savings tool, which is why your tax and financial advisors are telling you to max these Roth IRAs out. So who can contribute to a Roth IRA? So it's similar to a traditional IRA. You must have earned income. Okay, you must have earned income. And your modified adjusted gross income limits exist that limit you to contributing to your Roth directly. So single, it's less than 139,000, married less than 206,000, similar to the ones we talked about with traditional. But you guys, there are things called backdoor or conversion options available. All right, so if you are above those income thresholds, this is something that you absolutely should be talking to your tax and financial advisors about. All right, whole big conversation for a totally different day. Be a training all in itself. So what are the rules of a Roth IRA? So in addition to the income limits that we just talked about, the same $6,000 contribution limit exists just like the traditional as well. So $6,000 2020 contribution limit, extra $1,000 if you're over 50. And same thing, contributions can be made up until you file your tax return. All right. So one more thing to keep in mind before we start talking about the types of IRAs available for employers, okay, or for self-employed. You can have a traditional and a Roth, okay, totally fine. But your individual contribution limit for both is $6,000. Okay, you can't contribute $6,000 to each. $6,000 total, or $7,000 if you're over 50. So you can put a little here, a little there, however you and your financial advisor think is best. But I typically do recommend that people max out their Roth IRAs first, if they can, because again, it is a tax savings tool, not just a tax deferral tool. Okay. All right, so now here's the fun part for my business owners, my self-employed. So traditional and Roth IRAs that we just talked about, those are on an individual level. So me as an employee, me as a taxpayer. All right. The two types we're going to talk about now are coming from a business point of view. So not you, the business owner, not you, the taxpayer, the business itself. All right. And these exist whether you're a Schedule C, a partnership, an S Corp, all the things. All right. So the first one, and this is my favorite, is the SEP IRA. It's a self-employed pension IRA. So what is it? So the SEP IRA, so the contributions that are made again, are made by your business, not by you, the individual. So they are a business deduction on your business tax return. So if you're a Schedule C business deduction on your Schedule C. If you're an S Corp, business deduction on your S Corp return. All right. So it's a business deduction. SEP IRAs are perfect. You guys, to me, they're a no-brainer for those of you that have no employees. All right. If you have no employees and you are not contributing to a SEP IRA, you're leaving deductions on the table. All right. This is something that you and your tax advisor should just be, it gets calculated with your tax return, right? And it's just a contribution that you should be making assuming you have the cash. All right. And they are available if you have employees as well, but we'll talk about why it may or may not be as good if you have employees. But if you have no employees, a SEP IRA, top notch. All right, so who can contribute? Again, any business can contribute to their business owner or employees' SEP IRAs. So what are the rules? So SEP IRAs, SEP contributions, can be made in the amounts up to 25% of earned income. Okay, 25%. That is the highest percentage of any of the retirement plans. All right, so for 2020, there is a max of $57,000. But you guys, that's 25% of $216,000 of earned income. All right, I know there are a number of you out there that are making over that 216, but I know there's a lot of you that are definitely under that threshold. Okay, so for Schedule C businesses, the contribution amount is going to be calculated when we file your return, because there's a little bit, the calculation's a little bit more complex. But the 25%, that's based off your net earnings. All right, so your gross revenue for your Schedule C minus all your expenses equals your net income, right? Then we use that net income to calculate your SEP contribution, which is then deducted from your business, bringing that net income, that taxable income down even more. All right. If you're an S Corp, it's 25% of your W-2 wages. So this is an even bigger reason we are always talking about reasonable compensation as an S Corp. Another reason to have a reasonable compensation, because you increase your chance of you increase your contribution amount of your SEP IRA. And then again, I want to say it's great for those of you with 0 employees. And the reason why is because if you do have employees, you are required to contribute the same amount to all of your full-time employees. All right. So if you have 3 full-time employees, or even 1 full-time employee, that's something to keep in mind, that if you're contributing 25% to your business owner SEP, you also have to contribute 25% to your full-time employees SEPs as well. All right, so there's definitely an additional cost there if you have employees. But for some people, this is kind of an added bonus, something to entice your team to, an extra benefit for them. Okay, so a few other notes on these SEP IRAs. So you guys, the SEP contributions that the business makes, that is completely separate from those individual IRA contributions we talked about, the Roth and the traditional on the individual level. So your business can contribute 25% of your earnings to the SEP. And then assuming you still have earned income left, you on your individual level can contribute to a Roth or a traditional IRA as well. Okay, so very, very cool. So the last thing I want to talk about today, you guys, is called a SIMPLE IRA. SIMPLE IRA. So what is this? It is essentially, it's a small employer version of a 401k. And it's a retirement plan option that allows the employee to defer part of their compensation. Okay, it's very similar to a 401k. Okay, but it also has an employer matching aspect to it. All right, so employee deferral, meaning my gross wages are $50,000 and I want to contribute I want to defer 5% of my compensation on the individual level to my retirement, to my SIMPLE IRA. I can do that, and that's lowering my taxable income on my individual level. All right, but as an employer, which is who we're kind of talking about today, right? There also is this employer matching aspect. So let's talk about the rules. So employees can defer up to $13,500 worth of their compensation toward a simple IRA. That's the 2020 number. This number is going to adjust every year. As a business owner, you are going to match up to 3% of what your employees contribute. So simple IRA is what we have at my firm because we have three employees. All right. And so as employees, they can contribute as much as they want up to that $13,500. But so they contribute 3%. I match 3%. If you have an employee that chooses to only contribute 1% of their compensation, then I only have to match 1% of that compensation. So it's an employer match. So whatever the employee contributes, as the employer, I'm going to contribute that same amount, up to 3% of their compensation. So you guys, this is a great option for the small businesses who have employees, right, and want to offer a nice benefit to those employees. Again, it's similar to a 401k and how it operates, but it's not the high fees. Okay, we will talk about 401ks and solo 401ks next week. And we're going to learn that 401ks have high administration fees. Simple IRAs do not. All right, so that's it. So that's my spiel on IRAs. All right, so just a quick recap. We got a few more minutes and I don't see any questions. So on an individual level, we have traditional IRAs, tax deferral tool, Roth IRAs, tax savings tool, okay? Then on an employer level, we have a few options. So on a business level, we have SEP IRAs, which are perfect. And I think a 100%, you must be doing this if you have no employees, okay? I can't stress that enough. And if you do have employees, you can also offer a SEP IRA to your full-time employees. But another option, if you don't want to contribute such high percentages, is the simple IRA, which has a 3% match to it from the employer perspective. So again, when you're looking at these, when you're comparing SEP to simple, if you have employees, it comes down to first how much you want to contribute, right, to your own. Because if you were like, I am absolutely going to contribute 10% minimum to my retirement plan, then you have to be willing to fork out the dollars to contribute 10% to all of your full-time employees as well. Okay, so the SEP gives you more flexibility to offer more if you want to. You just got to make sure you're staying uniform. The simple is a flat 3% max. Okay, and that match, whereas a SEP, you have to contribute whether they want, what your employees want has nothing to do. It's all a business contribution, the SEP is. The simple is a match. So if your employees don't contribute, you don't contribute, and you're maxed at that 3%. All right. So next week, you guys, like I said, we're going to talk about 401ks and solo 401ks, which I'm learning to like more and more. And then I just want to end with a few announcements. Remind you guys that 2019 tax season is close to being over. We have less than a month left until the October 15th extended filing deadline. This is the deadline for my C corporations and my individual tax returns. So those of you with a Schedule C, okay? You've got to get your return done by October 15th. I do want to let you guys know, so individuals, okay, October 15th, that is your deadline. And if you owe money, okay, and you do not file your return by October 15th, regardless of whether you can pay, right? If you do not file by October 15th, you're going to get a 5% failure to file penalty assessed for each month you don't file. All right, 5% of what you owe. Okay, so if you owe $1,000, 5% of that is $50. Okay, keep in mind though, if you do not owe money on your individual tax return, there won't be a penalty for filing late. All right, so that's something I keep getting questions about the last few weeks. I just want to throw that out there. We are past our deadline to get your documents to our team to ensure this October 15th filing. But if you know you're not going to owe money and you can file your return a little later, you're happy to reach out to us and we'll help you out. But we can no longer take on any new clients for that October 15th filing. Okay, we're at capacity. But there are plenty of ways that you guys can still work with us if you're interested in it. 2020 tax planning, I know you guys keep hearing it, but it's going to happen in November. It starts in November. So if that's something that interests you, definitely make sure you're on our email list. And those details of the tax planning packages, the scheduling, the pricing, they're all going to start making an appearance probably next month in October. So we can actually get started on tax planning as soon as we can in November. And then one more shout out to my PPP and EIDL borrowers out there. Don't forget, we have multiple options for you if you need help with your PPP forgiveness or anything PPP or EIDL in terms of maybe figuring out how to spend your money, what's allowed, what's not allowed, what documentation do you have to keep, whatever questions you have. So first we have our personalized PPP strategy sessions. Okay, I have hundreds upon hundreds of hours of PPP and EIDL expertise, you guys. So this is your chance for me to share one-on-one with you in a 30-minute recorded Zoom call, all of that information, all of that knowledge. All right, it can be PPP, it can be EIDL, your choice. So we've already actually started having some strategy calls and we're getting awesome feedback. I do know a lot of people are waiting for this next step of Congress to pass, and that is totally fine. The only people that should kind of be concerned with might be concerned with getting their application submitted sooner rather than later are those of you that are worried about the FTE requirements or the hours requirements. So if you're looking to lay people off or cut hours, you definitely want to check with your bank and see if you need to get that, if you can get that application in sooner rather than later. Otherwise, I don't think there's a rush because we are hoping to get some blanket forgiveness rules whenever Congress passes anything. Okay. And you guys, the thing here is, even if you have a CPA you love that you don't intend to leave for tax work, you are welcome to these PPP strategy sessions with me to just get help with PPP and EIDL specific things. All right. And for those of you that are not DIYers, I hear you. Not me. I don't do anything that I'm not comfortable doing or don't. Yeah, I'm like that. So if you're one of those people that's like, I want nothing to do with completing this work, please, I need someone to do it for me, then we are providing full service PPP forgiveness application completion services. If that interests you, you definitely want to schedule a free consultation with me to discuss the pricing and services for that. So I'm going to put that link here. So the consultation link will take you to both the free consultation and the strategy sessions. See if that works. Oh, I have friends on. Thanks. We're getting there. So that's that. Okay, cool. So that's it for today, you guys. I will see y'all Thursday at 2:00 Mountain Standard Time. We'll go over updates if we have any. We haven't for the last couple of weeks. So that is your chance to come in and get your questions answered. They don't have to be PPP or EIDL related. They can be anything accounting and tax. All right. So there we go. You guys have a great week and I will see you on Thursday afternoon.